Is gold a sound investment? Does gold act as a hedge against inflation? And how do I make money blogging anyway? We'll answer these questions and more on this, the 58th episode of the DoughRoller podcast.
Welcome to the DoughRoller podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, welcome to the 58th episode of the DoughRoller podcast. I'm your host, Rob Berger, and I got a lot packed into today's show, so I want to get started. The main topic, which we'll get to in a minute, is a question that I've gotten a number of times from readers, and so I thought I'd finally put my thoughts together in a podcast for you, and that is gold a sound investment? And we will talk about that in just a little bit. Before we get to that, though, I've been getting a lot of email from folks asking me how they can make money blogging. And I've been a blogger now since 2007, and over those years, I've gotten literally hundreds of email from folks asking that very question. And I always struggle with that kind of email because while I've written some about how to make money blogging, it's not the main topic of DoughRoller. And so I don't have a lot of content that I can share with folks. And I've toyed with the idea of starting a separate blog about how to make money blogging. And I've got some plans in that regard that I'll talk about perhaps in a future show. But I got another email from a reader with that very question this past week. And I was just kind of frustrated that I didn't have something more that I could give her. And so I thought, you know what I'm going to do? I'm going to see if there's an interest in a webinar. And so in the newsletter that goes out every Saturday, I had at the top of the newsletter, I said, hey, listen, if you want to know more about how to make money blogging, if I can get 5 people that are interested, I will do a free webinar where you can ask me whatever you want. We'll set it up for like about an hour, and you can just pummel me with questions about how to make money online, how to make money blogging. But I want to see, at least 5 people that would be interested in that. Well, my inbox was flooded. I literally spent the entire morning today responding to email. It was amazing. And in the newsletter, if you're signed up for the newsletter, I also said I would do a webinar for folks that might not be interested in blogging, but that are interested and have some questions about personal finance and investing. Since that's what we're here to talk about, I thought I ought to include that. So I thought, well, I'll do a separate webinar if folks are interested in asking questions about personal finance and investing, and the response to that was overwhelming. A lot of people are interested in both webinars. It was really a humbling experience to see all the great email that came in. And so I am in the process of now I've got to figure out how to do it, right? I offered this, now I got to figure out how in the world you set up a webinar. And so I'm working on that. But if you're interested in either or both of those webinars, I highly recommend that you subscribe to the newsletter. You can do that at doughroller.net/newsletter. I only send out one a week, so you will not be bombarded with email. I don't do that. I send out one newsletter on Saturday, and there'll be more information in upcoming newsletters about those webinars. You can also shoot me an email at dr@doughroller.net if you're interested, but those webinars will be happening once I figure out how to make them happen. And hopefully they'll be a help to you. That's why I'm doing them. And so that'll be something to look forward to. And I thought, since we were talking about making money blogging, I wanted to mention something. One of the big ways that bloggers make money are through affiliate relationships. So how do those work? Well, I'll give you an example that I think everyone can relate to, and that is Amazon. So if you're a blogger, you can sign up for Amazon's affiliate program, and you can link to any page on Amazon with a special affiliate link, whether it's a book that they sell or a product, whatever. And then if your readers click on one of those affiliate links and they're taken to Amazon and they buy a product or a book or what have you, you'll get a small commission. And that's basically how all affiliate relationships work, at least that I'm familiar with. And Amazon is a good example. But banks, in the personal finance realm, banks have affiliate programs, brokers have affiliate programs, the credit score industry, credit cards, investing. So there are a lot of affiliate relationships, and it's something that it's very important to me that I'm transparent with those affiliate relationships with you. So, for example, on every page of my site, I have a full disclosure of these affiliate relationships. And if you listen to my 31-day money challenge, I had sponsors for that challenge, and I've disclosed those in each of those podcasts. That was Betterment and Personal Capital. And I thought this would be, just before we get into the main topics of today's show, I wanted to mention to you sort of my own sort of 3 rules of the road for affiliate arrangements. These are sort of the rules I follow for myself, whether it's for the podcast, my newsletter, the blog. And I thought it was important to share that with you so that we're all on the same page, and just to be fully transparent with you all. You're kind enough to let me into your lives for 30 to 60 minutes with each podcast, and I think you have a right to know all of this. So here are my sort of 3 rules of the road. One is I only promote products or services that I believe in. That is very important to me. The vast majority of products that I mentioned that I have an affiliate relationship with, like Betterment and Personal Capital, are tools or services that I personally use. There are times when I might promote something that I don't use, but I would use it if the need arose. So that's the first thing. I only promote products that I believe in. That's number one. The second rule for me is no advertiser has editorial control over my blog, newsletter, or podcast, period. And the good news there is I've never had one try to take control over what I say about their products. And there are certainly times when I will mention the shortcomings of a product, even where I have an affiliate arrangement. Absolutely. And there are also times when I'll talk about a product and point out that, I think it's a great product, but it may not be right for everybody. One of the hard things, I'll give you an example of that, is Vanguard. Now, I do not have an affiliate relationship with Vanguard. If you've listened to this podcast, I talk about Vanguard all the time because I'm a big believer in the mutual funds and their low costs and index funds. But I don't have an affiliate relationship with them. But as much as I use Vanguard and believe in what they offer, I do recognize that some investors want someone else to manage their investments for them. And so when I talk about Vanguard and I respond to email from folks, I believe in Vanguard. I think it's very easy to manage your investments with Vanguard. That's what I've done. But I recognize that you may need to do something different for you and your family, and you may want someone there to manage your investments for you. And so, again, as highly as I think of Vanguard, I know that it's not the right solution for everybody. And the same is true with affiliate products that I discuss, like Personal Capital. I love Personal Capital. I log in every single day to look at my investments and to track them and to track the costs. But they're not the only tool out there, and you may find a tool that you like better, and that's great. So again, they don't have any editorial control over what I produce, and I also recognize that whatever I think about a product or service, it may or may not be right for you. So again, I only promote products I believe in. No advertiser has editorial control over my blog, newsletter, or podcast, or anything, any content that I put out there. That'd be true of social media, for example, as well. The third thing, and that's really the point of this sort of beginning to this podcast, is transparency. I think it's important that you understand that I have these affiliate arrangements. And what I do, and I'm going to do on this podcast, is if I mention a product or tool on the podcast where I have an affiliate relationship, I'll let you know. I'll tell you in the podcast so that you know. But here's the thing. Whether I have an affiliate arrangement or not, it's still critical for you to assess what's right for you and your family, whether, again, it's an investment, a financial tool, whatever. Regardless of my affiliate relationship, which I will disclose, you still need to assess what's right for you and what's not right for you. And just because I do have an affiliate relationship doesn't mean it's wrong for you. And even if I don't have an affiliate relationship, it doesn't mean it's right for you, if that made sense. Anyway, transparency is important to me. So as I mentioned, products or services that I have an affiliate relationship with on the podcast, I will let you know. By the way, that's really how this show is possible. I do make the commissions from affiliate arrangements through the podcast and the blog, and it's what allows me to continue to produce this podcast and write for the blog. And so to the extent you do use an affiliate link, I appreciate it. Thank you. You've helped me make this show a reality. So with that, let's get to the money tip of the day. And this actually comes from a reader named Steve. And the tip is this: pay your credit card before the payment is actually due. Here's what Steve had to say. He says, I've got a little money tip for credit cards. Let me know what you think. About 6 months ago, I started paying the amount due as soon as I received the bill. This way, I only have 1 month's worth of expenses on my cards at any time rather than 2 months I used to have when I paid on the due date. This keeps my utilization rate low, which, as we know, affects credit scores. Do you think this makes enough difference to affect one's credit score, he asks. All I know is mine is at an all-time high and broke 800 for the first time. Well, first, Steve, great tip, and congratulations on that credit score. I mean, with a score of 800, for FICO, the best score, the perfect score, if you will, is 850, except that you don't really need a perfect score. Basically, anything over about 760 to 780 will get you the best terms on any loan you could possibly get. So, man, you've gone over 800. You've hit a home run as it relates to credit scores, and congratulations on that. And for those listening, he mentioned utilization rates, and so let's talk just briefly about that and Steve's tip. So, utilization rate is simply this: the amount you have on your revolving credit, which is primarily credit cards, but it could be other lines of credit, divided by your total credit limit. So, for example, if you have just one credit card and your total credit limit is $10,000, but your balance is just $5,000, your credit utilization is 50%. 5,000 divided by 10,000. And the way FICO calculates credit utilization, they look at both your utilization for each individual credit card or line of credit, and they also look at your credit utilization as a whole, aggregating all of your lines of credit and all of your credit cards. They look at both. And credit utilization is a huge factor in your FICO score. And I had the opportunity to interview Tom Quinn on the show. He is the credit expert from FICO. I mean, you couldn't ask for a more knowledgeable person on the FICO credit score. He came on the show. It was actually the second show. So this would be DoughRoller.net/podcast2 if you want to listen to it. And what Tom said is the most important thing for your credit score is your payment history, paying your bills on time. Period. That is the most important thing. But the second most important thing, credit utilization. And what he recommended is that you really want to keep your credit utilization below 30%. So if you had $10,000 in available credit, you wouldn't want your balance to go over $3,000. And really, the lower, the better. So, it's not, if it's above 30%, you get dinged, and as long as it's below 30%, everything's fine. 20% would be better than 30%. 10% would be better than 20%. You get the idea here. Now, I don't want you to think that if you go over 30%, it wrecks your credit score and you lose hundreds of points. It doesn't quite work that way. But credit utilization is very important. And the reason is this: if you're maxed out on your credit cards, what that tells the folks at FICO is, boy, there could be a problem here. If something goes wrong in your finances, you don't have a lot of available credit to deal with it. And you're really kind of living life on the edge, so to speak. And so they like to see a lot of available credit. And so that's why it's important. And if you can keep your utilization rate at least below 30%, that will help you keep your credit score up. Particularly important if you're looking to perhaps buy a home in the near future or perhaps refinance your existing mortgage. Now, that's a little bit of background. Let's get back to Steve's tip. Why does paying off your credit card the day you receive it versus the due date, which might be, let's say, a couple of weeks later, why will that help? Well, for credit utilization, the credit bureaus take a snapshot in time of your credit each month. And so when they take that snapshot, you may have whatever balance on your credit card, even if you pay your card off in full. You're going to have a certain balance probably on the day that they take that snapshot. And that's what they will record for your file for that month, even if you pay the card off in full the very next day. They're not taking a snapshot every day of the month. And so when they take that snapshot, again, whatever you have, whatever your balances are, that's what they are, and your credit utilization is calculated accordingly. And that's what will go into calculating your score for that month. And so by paying your bill off when you receive it, it helps you to keep your balance lower. If you were to wait and to continue to charge the card up and then pay the balance on the statement when it's due a couple of weeks later, you've increased obviously the balance on the card as you've continued to use it, and that then increases the chances that when they take that snapshot, your credit utilization would be higher. Now, I'll add one other thing to Steve's tip, and this is something that I've done. One of the hard things about using a credit card is budgeting, because when you're using your credit card, the money's not coming out of your bank account, and if you're looking at your bank balance to decide how much money you have left to spend that month, it can be really deceiving because you've got to factor in that credit card. That's one of the things I like about YNAB. I don't look at my bank balance to decide how much money I can spend that month, how much money I have left over. I look at my budget. But boy, it's tempting to look at that checking account balance, and if you see however much in there, it can be tempting to think that's what you've got left to spend, even though maybe you've been making charges on your credit card. So one of the things I do, I guess it kind of takes Steve's tip even a step further, and that is there have been times when I'll make multiple payments on my credit card throughout the month. I mean, it's easy to do. I can log in to either my bank and initiate a payment, or I can log into my credit card on the credit card issuer's site and make a payment. And so sometimes I would make multiple payments a month to force my checking account balance down so that I wouldn't think I had more money to spend than I actually did. So that's just a thought. Maybe that'll help you with your budgeting. But I appreciate Steve's tip, and I think it's a good one, and maybe it'll help you with your finances. So now a question from a reader named Aaron. Aaron wrote in and he said, "Hi, Rob. I enjoy reading your tips and have put a lot of them in place for our savings retirement. My question is, what is your view on adding gold and silver to a portfolio, and how much?" Well, Aaron, that's a great question, and it leads right into our topic today. Is gold a good investment? And I'm going to run through 6 reasons why, frankly, I think it's not a good investment for most people most of the time. So first, it doesn't produce anything. If you own an ounce of gold today, a year from now, 10 years from now, 100 years from now, it's still going to be 1 ounce of gold. In contrast, if you own, say, stock in a company, companies produce things. They produce, if you're ExxonMobil, they produce oil and refine oil into gasoline that has a market. Or maybe you invest in Apple and they produce consumer electronics that are in demand. But the point is that companies produce things of value, and so your investment in a sound company can and hopefully will grow over time. And it's not just about the stock market performance, but hopefully the company's assets are growing, its earning potential will be growing, its actual earnings should be growing, and if it's paying dividends, the amount of those dividends should be increasing as the company enjoys growth. And in fact, sound investments over time, you'll end up recouping far more in dividends than your initial investment. Of course, that takes some time, but that's exactly what a sound investment in a good company will do. They produce something. Gold doesn't produce anything. And if you think about it, how might you go about valuing a company, whether it's a public company or a private company? Well, you'd look at its assets. You'd look at perhaps its past performance. You'd look at its market position. And all of this is to determine its income-generating potential. Right? That's what you'd be doing whether you invested in Apple or you invested in a local dry cleaner. In fact, this is sort of the topic of podcast 23, which was part of the 31-Day Money Challenge, when I talked about why we should all invest like business owners. You can check that out at DoughRoller.net/podcast 23. But the point is, as you're evaluating a company, you're looking at what it can produce ultimately in the form of income. How would you value an ounce of gold? You can't even think of it the same way as you would investing in a company. There's no way to value it other than to go look at what someone else is willing to pay for it. And that's because gold doesn't produce anything. So that's the first reason I don't like gold as an investment. Now, you might be saying, yeah, but it does have some uses. That's true, and this gets me to the second point. It has some uses, just not a whole lot of them. It has some industrial applications, and of course, it's used in jewelry, so it has some, decorative uses. But these uses pale in comparison to the supply of gold. There's simply no way that its industrial uses, its decorative uses can match the available supply of gold. You think about other commodities like crops, or again, going back to oil and gas. These commodities have significant uses that ultimately determine the price of these commodities, the supply and demand of these commodities. Certainly, there is a supply and demand element to gold, but not anywhere near other commodities, and certainly not anywhere near something like a company that produces something, as we talked about a moment ago. So that's the second problem I have with gold as an investment. It doesn't have a whole lot of use. The third reason I don't like it is its long-term real return is abysmal. I know that when gold goes flying up in value, it gets a lot of press, a lot of attention. Everyone's talking about it. And we certainly saw that in gold's run-up. I guess it went up through 2011. It's since fallen quite a lot. And if you're old enough to remember the run-up in gold, I think, oh goodness, we're going back to, I want to say 79 or 80, when the price of gold went up to $850 an ounce, I think was the number. It got a lot of attention then, and a lot of fanfare, a lot of news. But long term, gold really doesn't go up that much. In fact, one study, and this was mentioned in an article in the New York Times, which I'll link to in the show notes, it looked at the return of gold over a very long time period from 1836 all the way up to 2011. And once you factor out inflation, its long-term return after inflation, 1.1%. Now, to put that in comparison, Treasury bills returned about 1%. We'll come back to that in a minute, by the way, because you might be saying, gold returned 0.1% more than Treasury bills. Well, that's true, but there's a catch. I'll come back to that in a minute. But why stop there? Long-term bonds returned on inflation-adjusted basis 2.9%, and stocks 7.4%. Gold's long-term return, notwithstanding all of the fanfare it gets when it's on the rise, is terrible. Now, I mentioned Treasury bills. That gets me to the fourth reason I'm not a fan of gold as an investment, and it's this: it's extremely volatile. As we can see, even in recent times, it can go up quickly, but man, can it go down quickly. Yeah, its inflation-adjusted return is a tad bit more than Treasury bills, but its standard deviation is over 13, which is huge. It basically has the volatility of stocks and the returns of Treasury bills. I mean, it's like the worst of both worlds. If you're gonna assume the volatility that comes with gold, why not enjoy the returns that come with stocks? All right, the fifth reason. There are some real headaches with investing and owning gold. The first is storage. It costs money to store gold. It's of course subject to theft and destruction. Now, there are ways around that. I mean, for example, you can invest in ETFs as a way to get exposure to gold. So storage isn't, there are ways around it. You can also just pay someone to store the gold for you. But storage is an issue. And the bid-ask spreads can be significant. You go to a coin dealer and you want to buy an ounce of gold. Well, the difference between what they'll buy gold for from you versus what they'll sell it to you is pretty significant. We talk about bid-ask spreads in the context of, say, stocks or ETFs. Well, the same thing applies to gold. I mean, I know this from my own adventures into buying coins, and I kind of view coins more as a collection than an investment. But the bid-ask spreads on investing in gold are not insignificant, and that adds to the cost. So there are some real headaches with investing in gold. Storage and bid-ask spreads are two of them. The sixth and final reason I'm not a fan of gold as an investment is this: notwithstanding what you might read, it is not a good hedge against inflation. So that's one of the big arguments from folks that love gold. They say, well, when inflation goes up, so does the price of gold, and so it's a hedge against inflation. But studies actually show that that's not true. It can be a hedge against crisis. When the financial systems are in crisis mode, like they were in 2008 and 2009, gold tends to go up, and that's exactly what we saw. But they're not really a good hedge against inflation. And just as an example, I mentioned that gold rose to about $850 an ounce in, I think it was 1980. Well, by 2002, guess what its price was per ounce? $293. It had fallen to a third. Now, what did inflation do during that same period? Well, it was up on average 3.9% per year. So while the price of goods basically doubled, the price of gold fell to a third. So notwithstanding what you may have read, at least in the short and intermediate term, gold is not a great hedge against inflation. It may be a decent hedge against inflation when you look at 100-year time periods, but I don't think most of us will be investing for 100-year periods. So it's not really a great hedge against inflation. So that's my view on gold. I do have a commodities fund, as I've mentioned. I have 5% in DBC, I think is the ticker, which is a commodities fund, and it does own a little bit of gold, but that's really a small portion of its total investments. It's investing in all different kinds of commodities. If you want to know more about my investment portfolio, you can check out podcast 29. That's DoughRoller.net/podcast 29. And if you listened to my podcast on motif investing, I interviewed Tuan Ghosh, who works at Motif Investing. And by the way, Motif Investing is I do have an affiliate arrangement with Motif Investing. I want to disclose that. But one of the things I questioned was why some of their motifs have direct exposure to gold. And he gave his view on that. I think that may be changing, but I'm not a big fan, which is one of the reasons I asked that question. I don't have, other than perhaps a small amount in that commodities fund, I don't have any exposure to gold in my portfolio. I just don't think it's a wise investment. Now, love to hear from you if you disagree. You know my email, dr@DoughRoller.net. Man, fire it up. Tell me why you think gold is a great investment, and I will read those answers on a future podcast, because I like to encourage discussion. I like to encourage a difference of opinion. So for you gold bugs out there, I want to hear from you. Let me know why you think gold is such a great investment. So that brings the show to a close. It's been a long time since I've played this outro music, and I'm playing it on behalf of Steve, the guy that left the money tip of the day. He didn't like the way I was ending the show without the music, so I'm bringing the music back, thanks to Steve. I hope you enjoyed today's show. A couple of things. If you haven't signed up for the newsletter, please do, DoughRoller.net/newsletter. That's where I'll have information about the webinars on blogging and personal finance that'll be coming up. And if you haven't yet, leave a review of the podcast on iTunes. If you do, shoot me an email. At the end of this month, April 2014, I am going to have a $100 Amazon giveaway. I'm looking for honest reviews of the show on iTunes. Shoot me an email that you left a review, good, bad, or otherwise, and you will be entered to win that $100 Amazon gift card. And thank you in advance for doing that. So until next time, remember, the best thing money can buy, you know what it is. That's right. It's financial freedom.